Hello, in today's video we're going to be taking a look at the Tuesday, October 14th trading session for the CBOE SPX index utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the newest version of that indicator which came out approximately 2 weeks ago, the V2.0 version. Okay, some of you may already be familiar with how this indicator works. For those of you who are not familiar with it, I will run briefly through it. We're going to try to make this video less long than we usually do. So if you do want to look at our other videos that can go into more detail about some of the trade setups and also some of the other aspects of this indicator, we invite you to look at those other videos which we've made recently. Okay, so the way this indicator works is that at 9:30 a.m. Eastern Time, you will get your daily key levels for today's SPX CBOE index on your TradingView chart. So you have to have your chart on the SPX CBOE symbol. This indicator does work on a second symbol called SPX 500 on the 8-cap exchange. The reason that it works on that second symbol is that allows you to get the levels 30 minutes earlier at 9 a.m. when it's on that particular 8-cap symbol via a table on the SPX 500 8-cap chart. So if you'd like to see the key levels for the CBOE index 30 minutes before it opens, then you can use the indicator on that particular chart. If you'd like to see a video on the features and setup, which goes over how to use the two-chart system, you can email us at daytradinggps@gmail.com to request a link to that setup and features video for the indicator. If you are interested in purchasing this indicator, you can email us at daytradinggps@gmail.com and request a discount promo code for purchasing the indicator at the link that's found in the description of the video. Okay, so at 9:30 a.m. Eastern New York time, you get your key levels on the chart. The most important level is the SPX Bull Bear Key Price level, which is abbreviated here KPL, which for today's session was 65.8696. You will also have your main R levels above R1 through R6, as well as the main levels below S1 through S6. When using this indicator, it is recommended that you expand your chart so that you can simply zoom in on primarily R3 through S3 in any given session. And then if price action takes us beyond R3 or S3, then you can minimize your chart or have the chart so it will include the other levels. Okay, so you will also see these midpoint levels between each of the main levels. So for example, this is the midpoint level of mid R2, R3. That's the midpoint between R2 and R3. Mid R1, R2 is the midpoint between R1 and R2. The mid BB KPL R1 is the midpoint between R1 and the Bull Bear Key Price level. Mid BB KPL S1 is the midpoint between the Bull Bear Key Price level and S1. The mid S1 S2 is the midpoint between S1 S2, etc., etc. So these midpoint lines are optional to turn on. By default, on startup, the midpoint levels between R1 and the BBKPL and S1 and the BBKPL are turned on by default, as well as the QL levels above and below the BBKPL. All the other midpoint levels or QL levels you can turn on manually in the user control panel. The midpoint levels are used primarily for stop losses on either bullish or bearish plays, depending on the level that you're trading. So for example, the midpoint level above The bull bear KPL is your standard stop loss level on trades that would be bearish trades taken from the bull bear key price level, and your midpoint level below the bull bear key price level would be your standard stop loss for bullish trades taken from the BBKPL level. It works the same on other levels. So for example, if you were taking a bearish trade off of the S1 level, your standard stop loss on that bearish trade taken from the S1 level would be the first midpoint above, and a bullish trade taken from the S1 level is your first midpoint below. There will be a section at the end of this video that'll be about 25 minutes long that will go into how to take trades off of the other main R and S levels. So we invite you to check that out, and also it will go into the two different types of trade entries, your standard trade entry as well as the more conservative trade entry, which takes more confirmations, and how to recognize each of those. Today we happen to have a trade on one of the other levels, which we'll go into here, which is the S1 level. So we'll have an opportunity to go over that in the main part of this video. You also have your YDH, YDC, and YDL levels. What those represent is yesterday's high, yesterday's close, and yesterday's low, specifically the RT8 session high, low, and close. The PMH is your pre-market high for today's session, and the PML is your pre-market low for today's session. Okay, so on the opening 9:30 a.m. candle, which we have marked off here for today's session, as you can see, it did open above the BBKPL level, and it did move down, but it did happen to wick below it, but still close above this level. So if you are going to take a trade off of the opening 9:30 a.m. candle, this is your bullish entry signal, because it did close above the bull bear key price level. This is a 2-minute chart. This indicator works on chart time frames of 1 minute up to 30 minutes. The recommended chart time frame to use for intraday SPX 0DTE option trades is the 2-minute chart time frame, which that is the chart time frame you will see on all of our videos that we make for this indicator on our YouTube channel. However, if you prefer a different time frame, you can use this indicator primarily on 1 minute to 5 minute time frames. That would be recommended for doing intraday trading. However, some traders like to use longer time frames if that is their prerogative. But again, the optimum time frame to use within 1 to 5 minutes is going to be the 2-minute time frame, and that is why we show it on our various SPX videos that we make on this channel. Okay, so when this candle closes, this 9:30 candle closes at 9:32, then you would take your bullish entry if you're going to take a trade off of this candle, off this opening candle. How you determine which call option to use is on the bullish play derived from the bull bear key price level. You want to use the closest call option to the bull bear key price level. It's 65.8696, so the closest strike, SPX strike to that is going to be 65.85. So it would be your 65.85 call option. The entry price on the candle close of this 9:30 candle for that option was $26. And the standard SL, standard stop loss, is going to be your first midpoint below the level that you're taking the trade from. So the level we're taking the trade from is the bull bear KPL. Therefore, since it's a bullish trade, the standard stop loss will be your first midpoint level below, which is this level here. If you prefer to take a tight stop loss, your tight stop loss will be the first QL, or QL below the level you're taking the trade from, QL below BBKPL, which is this level. As you can see here on this trade did not work out, both the tight stop loss as well as the standard stop loss were hit on this. Normally, we recommend to take the standard stop loss. However, some people prefer the tight stop loss. However, that is more prone to getting stopped out. However, in today's session, both of them did get stopped out. So here, the standard stop loss gets stopped out on this 9:34 a.m. candle. To make things easier, we're just going to go ahead and assume the stop loss on the low of the candle. However, as you can see here, you were stopped out earlier than the low of the candle. However, just to make things simple here, we'll just go ahead and assume the worst case scenario that you got stopped out on the low. So the low of this candle is 2020. So you paid 26. So your loss on this is $580. The reason it's $580 is, if you're not familiar with how options work, you multiply the price of the option times 100, and that's your cost of one option. So in the case of this call that being purchased at $26, that means one call cost us $2,600 because you multiply the cost times 100. Same thing on getting stopped out. We're stopped out at 2020, so that is $2,020. So if you multiply 100 times 2020, so the loss is $580. Now, we did have two opportunities to get into trades after this. This particular chart, we're just going to focus on the aftermath of the BBKPL second entry here. We're going to point out this other entry that you could have taken here, a bullish entry off the S1 level. And then after we get through with this, we're going to switch to another chart because there just wasn't enough room here to put all the different points for this particular entry along with these here. So if you follow along here, we did get a move down to the pre-market low, as you can see here. And what you're looking for here with this entry on the S1 level is you're looking for things to bottom out. So we have a move down, as you can see here. We haven't quite hit the pre-market low, so this is why this pre-market low is an important level to look at. So even though this candle comes close to it, we do not have a touch or a candle that is testing the pre-market low yet. So you would not jump into this trade here because we're waiting for things to bottom out, because we have a pretty fierce move down. We already got stopped out, so we're trying to be more careful since we've already experienced one loss on the session so far. So as you can see here in this candle, we did get a move down closing below the pre-market low. We did get a move back above the pre-market low here. However, we're waiting for confirmation of a move above S1, and also that it's going to stay above the pre-market low as well. So if you were going to take the standard trade here and get into the bullish trade off of this level, the S1 level here, it would first be on this candle here at 946 off a PMO hold and candle close above S1. If instead you were looking for additional confirmation, then you would have waited until this candle here, this breakup candle where it re-breaks above S1 and recloses above S1, and that is the 9:52 a.m. candle. Now, determining which strike you use on this particular entry is the same process so that we used here. So we're going to use the strike that is closest to the level that we're trading. The S1 level is 65.6891, so that would be the 65.70 call. If you entered here, then the price on the candle close here on this entry would have been 25.44. However, if you waited till this entry here for the reconfirmation, then that is at 9:50. It closes this 9:52 a.m. candle, and that is $29.10. Your standard stop loss on this trade, just like it was here, is going to be since this is the level we're trading from, it's the first midpoint level below the level we're trading. So that's this mid S1, S2 level here of 65.89.89. And if you prefer the tight stop loss, then it is the QL level below the level we're trading, QL below S1. As you can see here, if you got into this trade here, you would have gotten stopped out here on the tight stop loss. However, you would not gotten stopped out on the standard stop loss. As we said previously, and we've said in other videos, it is recommended to use the standard stop loss over the tight stop loss. However, everyone is different, and for those who still prefer to use the tight stop losses, even though they're more prone to getting stopped out, that's how you determine your the QL levels are going to be your tight stop loss. Okay, so on this candle here, if you got in on the confirmation reconfirmation candle and instead waited for this 9:52 a.m. Candle to get in at, then you were not stopped out on either one of these. Okay, so we're going to, after we get through running through this second BBKPL bullish entry here, we are going to switch over to another chart, which is going to go over how this trade worked out, because as I said, there's just not enough space to put the ones for those here as well as the ones we already have for this one. Okay, so moving along here, you have your BBKPL level entry 2. This was entry 1 over here for BBKPL entry number 1. That one got stopped out. This is entry number 2 off this level at the 9:56 a.m. candle close above the BBKPL. So you're going through the same motions here with this. Since this is the level we're trading here on this entry, you're going to use the same call option used here, which is the at the money call option closest to this level, which is the 65.85 call option. The entry price on this candle close here on this 9:56 a.m. candle is $23.40. You're using the same standard stop loss, which is the first midpoint below, which is the same one we used here, or if you're using the tight stop loss, then it's going to be the QL below. In this case, neither one of these stop losses was hit in this particular entry. And then now we're looking for target exits. So if you're just scalping, if you're the kind of trader that's just scalping, then you would have gotten out here on this wick touch here on this particular candle, because that is a one level move above. So if you're just scalping, then you're getting out on the one level moves. Most of the traders that are using this indicator are not scalping, and they're using the regular trades that we describe, which are the minimum 1.5 level moves. However, for those of you who are scalping, that is how you determine your exit level and 100% closeout. When you are scalping, there is no stop loss adjustment. When you hit the target level, you are just exiting 100%. Here, excuse me, here on the 10:20 a.m. candle, BBKPL level bullish entry 2, which is this one, hits the mid R12 level on the high wick of this candle. So that is your minimum 1.5 level target move. How you know it's 1.5 level target move is it's 1.5 levels above the level we took the trade entry from. So R1 is a one level move above the level we took the trade from, the BBKPL. So the first midpoint above R1 is your 1.5 level move. So on the wick touch, which that's where this touched this level, on the wick touch of mid R12, the call option was 38.22. So the profit on the gross profit on this is $1,482 per option, but our net P&L for the session is $902 for the session, because we had a earlier loss of $580. So at this point, as we've explained in our other videos, which you may have watched on this channel, at this minimum 1.5 level move, that's your minimum target for either 100% closeout or scaling out 70 to 90% if you are using multiple contracts, and then you would have the scaling out option. So if you're using multiple contracts, you can either close out all of them, or if you're using multiple contracts, multiple meaning primarily 4 or more, then you could scale out 70 to 90% of those and adjust your stop loss on the remaining runners. Adjusting your stop loss on the remaining runners involves you now adjusting your stop loss to break even or better on any remaining runners. And you're adjusting your stop loss on price now. Here you had a stop loss based on levels. Now you're adjusting your stop loss based on price if you're adjusting your stop loss on any remaining runners. So at that point, since we paid $23.40, you would, on any remaining runners, adjust your stop loss to break even at $23.40, or you could add a 10 to 15% profit buffer above to add on top of the $23.40. So for example, 10% would be roughly $2.35 that you would add to the $23.40, and then you would make your stop loss that price of whatever $23.40 plus the $2.35 is. If you added 15%, then you would add 15% to it and make it that. Okay, so here at 10:36 a.m. it hits the R2 level on the high wick of this candle here. Now we've reached the ideal minimum 2-level move for 2-level target move. At this point, the 65.85 call option is now 45.39 on the wick touch of R2 here. So again, you have a choice of either 100% closeout of all your contracts, whether you're trading one contract or all, or if you're trading multiple contracts, scaling out of 70 to 90% of them and adjusting the stop loss on remaining runners. Just as we did here, the same process as far as adjusting your stop loss. Okay, so here we have on this BBKPL level entry 2 at 11:46 a.m. on this candle here. It hits the mid R2, R3 on the high wick of this candle here. That is now a 2.5 level move. The 65.85 call option is now $59.30 on the wick touch of the mid R2, R3 level. The profit is now $3,590 per option. The net P&L for the session is now $3,010 per option, because remember we did have a $580 loss here. And just to go back to this one, I forgot to point out that when it hit R2, our profit was $2,199 per option on this price of $45.39, and our net P&L after taking out our loss is now $619 per option when it did hit R2. So here you have, again, either 100% closeout or scaling out 70 to 90%, adjusting your stop loss on remaining runners. If you already started having runners down here or here, then when it hits the next level up, then you would just add more if you're going to stay in the trade and not close out your runners, because at each level, if you, let's say you started here, at each level it moves more in your favor, you could either just close out the remaining runners or keep adjusting your stop loss on the remaining runners. So that's your decision that you would have at each level move up. And if you're just staying in it and adjusting your stop loss, what that means is that you're adding more profit buffer to your stop loss. So if you started out down here, when it hits here, then you would add more profit, say another 10 to 15%, and you would do the same thing here. So as you can see here, from the point that we started making this video, we already did get a hit of both the yesterday's daily close, yesterday's RTH session close, as well as the R3 level. So on this candle here, which did happen to close above the R3 level, you would do the same thing here. So I don't have the price of this option here, but if you look at the 66.41 to 66.59, that's about another 18 points. So this option is probably around $75 to $78 now. So that added on about another, say, $1,600 to $2,000 in profit per option here when it hits this level here. And then you would do the same thing again. You'd be either closing out all of the remaining runners, or you would adjust your stop loss by adding another additional profit cushion here if you want to see if we're going to hit YDH or even go up to the further level of R4. As you can see, we haven't turned on the mid R3, R4 level, but at this point, that's when I would go ahead and turn on the mid R3, R4 level to see if we first get a close above YDH. If we do hit YDH, that would be another point that's yesterday's daily high that you would want to make another decision as far as either closing out or making another stop loss adjustment. And then if you are staying in the trade and not closing out, if it does in fact hit YDH, then you would look for the next level up, which would be the mid R3, R4. Okay, so now we're going to pause the video and we're going to now look at how this trade would have worked out if you instead had just taken the S1 bullish entry. Okay, so now we're on our other chart here. We've taken off all the second entry for this because this is just for those who are looking at this S1 level bullish entry, which was either taking this entry here on this candle, as we pointed out earlier, or waiting for the additional confirmation and taking on this candle, the 952, whereas this was the 946. Okay. So as we went through this trade, so whether you took the entry here or took the entry here, your standard stop loss is going to be the first midpoint level below the level you're taking your trade from. And we were taking a 65.70 call option because that is the closest strike to the level that we're taking the trade from, the S1 level of 65.6891. If you instead had your tight stop loss, then it's the QL level below the level you're taking your trade from, whereas the standard stop loss is the first midpoint level. Okay, so we'll see how this trade's worked out here. As you can see, before we made this video, we had the last adjustment here, but as you can see, just like in the other trade on the other chart, we've now also hit the R3 level here, but you can get the gist of it from what we've gone over in these different touches here. So at 10:04 a.m. it hits the mid BBKPL S1 level here. So remember, your trade either started off this candle or this candle, but your trade is still derived from this level here. So you have 1.5 level move here. So S1 to the bull bear KPL is one level, and then the midpoint above the BBKPL is a 1.5 level move from S1. So that's when it hits this level here. That's the 1.5 level move. So that's your minimum 1.5 level target move, as we talked about on the other trade. The 65.70 call is now 37.50 on this candle close. The profit is $1,206 per option. As you can see, we did have a $580 loss here. I don't have the net P&L on these like I did on the other one, but you can just figure, we'll just go ahead just for simplicity's sake and call this loss 600, even though it's 580. And so now we have approximately just a little bit over $600 net profit per option at this particular point on the day, once we take out this loss that we had earlier. Okay, so same thing here, either 100% closeout because we've hit the minimum 1.5 level target move. So it's the same process, even though you took the trade down here instead of the other trade that we took off the bull bear KPL. It's the same exact process. we've hit a 1.5 level minimum target move. So we either have a choice of 100% closeout or scaling out if we're trading multiple contracts, 70 to 90% of them, and adjusting the stop loss to break even or break even plus a 10 to 15% buffer on the remaining runners. Here at 10:14 a.m. it hits R1 on the high wick of this candle here. The 65, this is the ideal two-level level target move. The 65.70 call option is now $44 on the wick touch of this R1 level. So now we've moved two levels. S1 to the bull bear KPL is one level. This is 1.5 levels. This is 2 levels. So same thing here, either 100% closeout or scale out 70 to 90%, adjust stop loss remaining runners. Here at 10:20 a.m. So here, just to go over real briefly, your profit is 1,856. Remember, we had a loss of 580, so we roughly have approximately $13, $1,200, $1,300 in net P&L on the day here after taking out this loss on per option basis. 10:20, it hits mid R1, R2 on the high wick of this candle here. This is a 2.5 level move. The 65.70 call option is now $50 on the wick touch of this mid R1, R2 level. The profit is now $24.56 per option. So you have the same 100% closeout or scale out option here. And of course, if you started adjusting your stop loss here on remaining runners, then as you are reaching each one of these levels, just like we explained before, then you would continue to add more profit buffer on as it moves up levels more in your favor. So 24.56 here. Loss, we'll round it off to 600. Now we're about 1,850 or so net P&L on the day here. At 10:36, now it hits the R2 level on this wick here, on this candle here. This is now a 3-level move. 65.70 call option, now $58 on this wick touch of R2 level. Profit $3,256 per option. Same thing here. Close out or make a further stop loss adjustment. And $3,256 minus, say, 600, rounding that up. So now we're at 2,600 or so net P&L on the day. 11:46 a.m. it hits the mid R2, R3 level here on the high wick of this candle. As you can see, it closed slightly below it, but it did wick above it. So this is now a 3.5 level move, starting from this S1 level bullish entry. So 65.70 call option is now 73.61 on this wick touch. And I did make a typo here. This should be mid R2, R3 levels, so my apologies for that. The profit is now $4,817 per call option. So rounding this up to 600, now we're up to approximately $4,200 per call option net P&L. As you can see here, we're approaching YDH now. We did hit on this candle here, the 1220 candle, the R3 level of 66.59.16. So as we stated earlier on the previous chart off of the other trade, there's approximately 18-point difference between these two. So when it takes out YDC and the R3 level here of 66.59. So 18-point difference, that's going to mean that this call option, is now going to be about $91. So at $91, that would be adding on about another $1,800 here. So now we would be up to $6,600 per call option. And when it hits YDH is about another 9 points above. If it actually does hit YDH, as we talked about on the other, then that would be another decision point here where you would 100% close out or do a further adjustment. And then we would do the same thing here we would turn on the mid R3, R4 level. If looking for if we ever do touch the YDH and close above it, for starting to move up to the mid R3, R4 level, and then perhaps even the R4 level. Okay, so as I mentioned earlier, if you are interested in purchasing this indicator, you can send us an email at daytradinggps@gmail.com to request a discount promo code to use to purchase the indicator at the link that's in the description of the video. If you would like to see the full features and setup video for this indicator, you can also request a link to see that. That is also sent to you automatically if you do purchase the indicator, but if you'd like to look at it before purchasing, we can send you the link to that. And now for those who would like to stay through to the next section will be a pre-recorded section that will go over taking how to take bullish or bearish trades off of the other main R and S levels. We did have an example of that today in this session that we already went over, but if you would like to stay to see that, it is approximately 25 minutes long, and it will also go over the two different types of trade entries to look for in that part of the video as well, your standard trade entry as well as the additional confirmation, more conservative trade entry, and what to look for in both of those and how to recognize both of those. Alright, so we're going to pause the video now, and then we'll move on to the final part of the video. And we thank you for watching today's video and wish you prosperity in all of your trading endeavors. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC. And we move down, here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session, and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPL S1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1 R2, mid R2 R3, mid S1 S2, and mid S2 S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is the QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1, and you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level. Your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1 because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1 because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say the price goes up to R2. Now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3 because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking the bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1 because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle or this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.